There's been quite a bit of discussion in recent times around the rise in bond yields. What I'm going to look at in this session, we're going to look at the ISM indices. They were out this week and surprised to the upside. Then we're going to have a look at the implications for bond markets. We'll look at some valuation anchor points, if you like, for bond markets, and then finally finish up with the discussion over the sector impacts of rising bond yields and steepening yield curve. So just to start off with and recap what happened with the ISM index this week. The red line is the service sector ISM, and that pushed back up quite sharply. Been volatile recently, but it was a very sharp increase. Um, and also the blue line representing the manufacturing ISM pushed up from below 50. In fact, it was 49.4 up to 51.5. So a nice little recovery out of the ISM indices for the US. What do the ISM indices tell us about upcoming GDP? Well, in this very simple model, using the manufacturing and the service sector ISMs as the inputs to a GDP model, the actual most recent GDP, we've seen the numbers around about 1%. Putting the most recent releases using a quarterly average of those suggests that growth should be closer to 2.5 rather than 1.5. So it suggests some upside in the GDP numbers for the current quarter, also for the December quarter. What we'll look at now is the correlation between the 10-year US Treasury and the various ISM indices. So what we're doing here is we're looking at 3-month change in the US 10-year, and over on the right-hand side, I'm using 3-month change in the ISM new orders index, the overall index, also the service sector index, and the overall service sector new orders as well. So if we look at over the last 10 years, we can see here it's ranking the correlations, quite a high correlation to new orders. And if we just sort of click onto that chart, you can sort of see the relationship over time is broadly held. Going back to that one, but in more recent times though, if we're focusing on just the relationship between the 10-year bond and ISM new orders, as I said, the correlation over the last 10 years has been around about 0.6. But if we go back and look at sort of shorter time horizons, shorter time periods, we'll see how that relationship has changed, not so much over the last, say, 5 years, but in particular, it's changed over the past 2 years, as you can see here. So the correlation had been averaging around about 0.6, and it's dropped away significantly, even more so in the last 12 months, where it's actually gone negative. So what's happening here? Well, we suspect that the QE policies by the ECB and also the BOJ have depressed bond yields globally, obviously through the chase for yield, and that has meant that the pickup in the ISM that we saw this year wasn't really followed through with a pickup in bond yields. Perhaps now that relationship is about to reassert itself, but it certainly hasn't held in the most recent period. What about valuations on bonds? So one of the metrics that we would typically use is comparing the bond yield to some sort of measure of trend nominal GDP growth. So here we've got the 10-year bond going back to 1970, again for the US. I'm going to put now nominal GDP growth for the US, but as a 60-month or a 5-year moving average. So if we add that, you see there that broadly they've followed over time. There was a period as inflation began to decline, that bond yields tended to trade above the levels of trend nominal GDP growth, but since the early part of the 2000s, it's tended to trade below. So if we then sort of make a comparison and we say, look, let's look at the difference between the 10-year and nominal GDP growth, and that's what we're doing here now with the gold line on the right-hand scale. So nominal GDP has been around about over the past 60 months, around about 4% over the past 5 years, possibly slightly below. We could say 3.5 or thereabouts, but that's been the average. So bond yields at currently around about 1.7 are something like 2% below the trend nominal GDP growth rate, a level that they attained back in during the GFC, and also a level if we go back even further to the mid to late 70s. So on that sort of very simple comparison to trend nominal GDP growth, bonds would also seem to be quite expensive. Finally, there's also talk around about steepening yield curves. Now, the steepening in the yield curve that we've seen to date is very, very minor. You can see it at the end of the chart here. So it's quite small by comparison of the big steepeners that occurred during 2013, 2009. You can see the shaded areas. So if we call those, if you like, market regimes, I'm interested to see how various equity sectors perform in relative terms during those periods. And I'll just pick on a few, some of those that tend to grab the attention. So, for example, banks. Now, we look at bank sector performance during these regimes. So the black line represents the steepening that began in October 2012. The numbers along the side here represent the relative outperformance or underperformance of the sector during that regime. So you can see there, obviously it's a mixed result. There's only really one bad regime, and that was October 2008. So clearly in the very early stages of the steepening, which was caused largely by the short end being cut, um, banks were underperforming. But by and large, the pattern has tended to be some outperformance by the bank sector. What about some of the interest rate sensitive? We choose, say, real estate, for example. By and large, they've tended to underperform as one might expect during curve steepening periods. We'll choose utilities as well, typically have been underperformers. One might expect the materials sector, that's very mixed, so we wouldn't read too much into that one. Diversified financials, the interesting one, seems to have been quite a strong outperformance during the curve steepening phases. So if indeed this is the beginning of a more significant curve steepening phase, then perhaps it has some significant implications for sector or sector relative performance. But as we noted, the steepening that we're seeing to date is very, very minor, and it's probably premature to talk about uh, curve steepening as being a major driver of strategy. Thank you.